Here's a mistake I see a lot of Canadian freelancers make. You start making decent money and your gut says, okay, it's time to incorporate. It feels like responsible next step, right? Like you're leveling up. But here's the thing, incorporate too early and you're paying extra accounting fees and compliance costs for basically nothing in return. Wait too long and you're overpaying personal tax and income you didn't even need to touch yet. So when is the good time to incorporate? There are two main reasons. A, your business has a liability risk, or B, the number tells you when to incorporate and actually start saving money. And I'll bet it's just not the number you're picturing right now. Stick around because I'm going to walk you through an actual Ontario example with real dollar figures and you can see exactly where that line is. Quick heads up before we get into it. This is financial education, not personalized financial or legal advice. Every business situation is different, so please confirm your specific numbers with a CPA before making a decision. So here's the instinct most people act on. You have good income year and you think, I'm making real money now, incorporation must be next. Makes sense on the surface. But here's why that's premature. Making more money isn't the trigger. What actually matters is whether you need all that money personally, your yearly expenses right now to live on. That one distinction is basically the whole video. So let's slow down on it. Here's the actual signal to watch for. Incorporating starts paying off once your business earns more than what you personally need to live on, because that extra money can stay inside of the corporation instead of landing in your pocket and getting taxed at your full personal rate. Let me explain why that matters, because this is the part that confuses people. When you incorporated, you're setting up what's called CCPC, a Canadian controlled private corporations. That's just the type of corporation most small business owners in Canada end up with. Corporations like this get access to something called the small business deductions, which is a reduced tax rate on active business income, meaning income your business actually earns from doing the work, not the investment income. In Ontario, that combined federal and provincial rate sits roughly 11.2% on your first $500,000 of active business income. Compare that to your personal tax rate, which climbs a lot higher the more you earn personally. I want to be clear here, this isn't free money, it's tax deferral on your marginal tax. You're still paying personal tax eventually whenever you actually pull that money out of corporation for yourself later, but at much lower marginal tax rate. What incorporating gives you is a gap, a window where that surplus can sit and grow at much lower tax rate instead of getting hit with full personal tax the moment you earn it. Let's lay out both sides honestly, because this decision cuts both ways. On the pro side, you get that lower tax rate on returned business income I just walked you through. You get the ability to leave surplus cash inside the company to grow before personal tax hits you. You get the limited liability protection, meaning there's a legal separation between your personal assets and your business. You got more flexibility in how you pay yourself, whether that's salary, dividend, or mix of both. You can also do income splitting with your family members. On the con side, there's real costs here. Incorporation fees, annual corporate tax filing, higher accounting costs. There's more admin too, a separate business bank account, proper bookkeeping, a corporate minute book. And if you're the type of person who withdraws every dollar of profit for yourself anyway, none of the tax benefit even applies to you. Here's what this looks like in real life. If you're spending everything you earn just to cover your life, there's no surplus left to defer. So incorporating at that point only adds bookkeeping, corporate filing, accounting fees with zero tax upside to offset it. Now flip it, if you're consistently earning more than what you need but you stay as sole proprietor, every dollar of that surplus gets taxed immediately at your full personal rate. You lose the deferral benefit year after year for as long as you wait. Quick question for you. Drop a comment below and let me know, are you currently sole proprietor or incorporated, and what made you decide that way? You can also comment on what topic do you want me to cover in the next video. Let's make this real with an Ontario example. Say you're a freelancer in Ontario earning $120,000 a year and you personally need $70,000 to cover your living costs. As sole proprietor, that $50,000 surplus gets taxed at your personal marginal rate, which for income in that range in Ontario sits roughly around 30% combined federal and provincial. So very roughly that's about $15,000 to $16,000 in personal tax on that surplus alone. Now compare that to living the same $50,000 inside the corporation. At Ontario's small business rate of 11.2%, that's roughly $6,000 in corporate tax. That gap of about $10,000 a year staying inside the business instead of going straight to tax, money that can keep growing or get reinvested in the meantime. Again, this isn't a final number and isn't free forever, because you will still pay personal tax whenever you eventually take out that money for yourself in the following years, but it shows you the shape of the gap we're talking about. One more thing worth knowing, Ontario's small business rate is actually dropping from 3.2% to 2.2% provincially as per July 1, 2026, which brings the combined decline rate down to about 11.2% going forward. So this gap is likely going to get wider. This example uses simplified numbers and doesn't account for things like CPP, the Ontario Health Premium, or specific deductions. So please treat this as rough illustration, not an exact calculation for your situation. Here's the part that actually makes the whole calculation possible in the first place. To know your real number, how much surplus you're actually generating, you need a clear, honest view of what you spend personally versus what your business brings in. That's generally hard to see when your accounts are all mixed together. This is where FANS comes in. FAN gives you interest up to 2.25% with no fees. Link is in the description below, and this is an affiliate partnership, meaning I may earn a small commission if you sign up at no extra cost to you. I use it myself to keep my business and my personal finance separate. A few important caveats before you go run your own numbers. The exact threshold shifts depending on your province, since small business limits are identical everywhere. A few provinces like Nova Scotia, Saskatchewan, and PEI actually have higher provincial small business limits than the federal $500,000 threshold. It also depends heavily on your personal spending needs and your industry. So here's the recap. The real signal for incorporating isn't your income level. It's whether you have income you don't personally need to touch and liability exposure. That's the number worth calculating, not some flat threshold you saw somewhere online. Before you decide anything, sit down and actually compare your personal spending needs against what your business brings in. That's your real starting point. Next up, I'll walk you through how to convert your health spending into tax deduction as corporation. I will see you in the next video. Bye.